video, we're going to be looking at amortization methods. So, before we continue, I'd encourage you to pause the video and answer these questions and check your understanding. What's another name for amortization? Well, that would be depreciation. What are the three factors in calculating amortization? It would be the initial cost, residual cost, and how much it depreciates each year. Cost, useful life, and residual value. What exactly is residual value? It's the cost of an asset at the end of its life. It's an estimated of an asset's value at the end of its useful life. For example, if you buy a car, how much is the scrap metal expected to be worth at the end of its life? Perhaps if you're planning to sell it secondhand, what do you expect to get for it? What is the net book value? The net book value is the value minus whatever the accumulated amortization is or accumulated depreciation over time. We're looking at lesson 16 today, amortization methods. There's three that we're going to look at particularly. Straight line is an amortization that uses the same amount per year. Declining balance, which produces a decreasing annual amortization expense over the useful life and is calculated as a percentage of the net book value. And finally, units of activity, which is expressed as the total units of activity of production that is expected from an asset. At this point, you should also understand that there are two types of expenses, capital expenses and operating expenses. Capital expenses would be an example of printer and paper. So the printer would be a capital expense, which is something which can survive from year to year. Whereas the paper is the amount of paper used in that year, so that would be considered an operating expense. So let's go and take a look at an example. Amortization, amortizable cost and rate. In this case, we're going to take a look at a flat rate or straight line balance. Amortizable cost is the cost of the asset minus the residual value. That's whatever we expect to get at the end of it. A truck costs a company $35,000 and has a residual value of $5,000. What's the amortizable cost? Well, it's going to be the cost of the asset, $35,000, minus the residual value, $5,000. It's quite high, but remember, we're doing this for learning purposes, and the expectation is that we're going to use easy numbers so that we don't end up doing things so that we can understand the concept, not necessarily how it will always work out in the real world. Amortizable cost, $35,000 minus $5,000 is $30,000. Using a straight line rate, it's going to be 1 divided by the useful number of years. Well, how long do we expect it to last? If we expect that the truck will last 4 years, well, that means that this is going to be 1 divided by 4, or 25%. Let's take a look at an example. Using straight line, a truck with an amortization cost of $30,000 is expected to last 3 years. Calculate the amortization expense of each year. This is kind of similar to what we were doing in the previous example, where we expected that the truck was going to be $35,000 with a residual value of $5,000. So we're just kind of extending it here. In this case, our amortization expense is going to be the total amortizable cost, which is $30,000, divided by the useful life, which in this case is 3 years, which is $10,000. So what that says to us is that every single year we expect that the truck is going to decrease in value $10,000, and we can expense roughly $10,000 worth. After 3 years, $30,000 is depreciated and the truck is valued at $5,000, the residual value. So let's just take a look at what this looks like graphically. Graphically, we see that the value of the truck is $35,000. Every single year is going down by $10,000. So 35 becomes 25, 25 becomes 15, and 15 becomes 5. We finish off at 5 because that's residual value. So we shouldn't expect to go any further than this. Also, emphasize that this is represented by the line y is equal to minus 10,000x plus 35,000, where the y-intercept is the initial cost of the vehicle, and the minus 10,000 is coming from the 33% of 30,000 because we expect it to last 10,000 or $10,000 a year. It's a minus because it's going down in value by 10,000 per year. Let's take a look at a different method of calculating amortization or depreciation. In this case, the declining balance is a little bit different and more complicated. The amortized value is calculated as a percentage of the net book value of an asset. This is the annual amortization expense would be the net book value times the straight line amortization rate. In the case of looking at a double declining balance method, we're taking the straight line rate, double it. So if the straight line rate was 30%, then it would be 60%. If it was triple declining balance, then it would be 3 times the 30, which would be 90%. So let's take a look at how this is going to work out. So in an example, the declining balance, we're looking at a declining balance. A truck with an amortization cost of $30,000 and a net book value of $35,000 is expected to depreciate 60% per year. Again, we're using easy numbers, and this doesn't match up with our other example, because if it did, then it would be 1 divided by 3, which would be 33% per year. Obviously, this is not quite what's happening here, and technically this would be closer to a double declining balance. So in this case, we're just being given that our depreciation rate is 60%. I'm doing that purposefully because you will find that we will be able to get this off the books in 3 years, and I don't want to deal with a huge chart. Generally speaking, the best way to do these problems is to create a chart. On that chart, we're going to have the year, the amortization expense, and the net book value. So how does this look? After 1 year, well, what's the amortization expense going to be? 60% times 35,000. Now we're doing this 35,000 because this is what we call the net book value. And the only reason why we have this $30,000 in the question is because we need to make sure that it does not drop below $5,000 of the residual value at the end. So here's our net book value after that first year is $14,000. So on the next line, we're going to put 2. We're going to do 60% of $14,000, which is going to be, wait for it, $8,400. Now we're going to calculate the net book value as being $14,000, the line above, minus our new amortization expense, which was $8,400, giving a net book value of $5,600. Now the last year is usually the trickiest, and you don't know when the last year is going to be. So let's take a look. Year 3 comes around, and we calculate it as 60% times 5,600 is 3,360, right? Except here's the problem. Net book value has now dropped below the residual value. So when this happens, actually, we end up doing something a little bit different. We modify it a little bit. How do we do that? Well, magic numbers, we end up making this 5,000, and that means that our depreciation expense is 5,600 minus the 5,000, which is 600. So there is a slight adjustment on the final year. So what does this look like? Well, here's the declining balance with a 60% depreciation rate, starting off at 35,000, and what we do start to see is that it's a curve. Now, this was modeled by an exponential curve. The only problem is it doesn't really match up perfectly, and the reason why it doesn't match up perfectly is because down here, this point, we end up adjusting so that it matched up with the residual value of 5,000. So we do see it declines as a curve over time. Here's another example where I've changed up the declining balance, and it also shows why I've used a very high percentage for the declining balance method, because imagine if I gave you this question where it was 10%. Look how many years, how long our chart would be. We'd be going all the way to roughly 18 or 19 years. It's way too long. But we also start to see is as we have more and more years that this curve will fit the data quite a bit better. Units of activity is a little bit different too. Imagine that you use a truck some parts of the year, or we don't use it at all in some years. How do we end up dealing with this? A truck with an amortization cost of $30,000 and a net book value of $35,000 is expected to last 300,000 kilometers. The first year, the truck is driven 60,000. In the second year, it's driven 100,000 kilometers, and in the third year, it's driven 30,000 kilometers. Calculate the amortization expense for each year. Well, in this case, we have to take a look at what is the unit of depreciation. In this case, we've calculated the cost per unit, and our unit in this case is kilometers. We're taking the amortizable value, dollars, divided by the total useful life. So $30,000 is the amortizable value divided by 300,000 kilometers, says that our depreciation cost is 10 cents per kilometer. The other way we could look at this is every time that we drive this vehicle, the value of it is going down by 10 cents. This is not looking at the operating costs. It is not taking into account gas costs. That would be something which would go under operating expenses. We're only looking at the capital expenditures. So what would this look like in the first year? Well, in the first year, we've driven 60,000 kilometers. So it's going to be 10 cents times 60,000 should be $6,000. In the second year, we end up driving 100,000, so it's going to be 100,000 kilometers times 10 cents, which is going to be $10,000 expense. And in the third year, we're going to be taking 30,000 times 10 cents, which is going to be $3,000. So in this case, there's no straight line, there's no curve. It can be varied according to what we're actually doing in the year. And actually, when we go into things like depreciation or looking at the value of a mine, something like a gold mine or oil, we approximate how much of the resource is there, and we actually could use unit cost to try and calculate the value of that asset over time. So let's just take a look at how this applies to real life. In real life, this here is something called a 4562 form. This is something that you'll find in the IRS. In the IRS, this form is used when you end up putting into service, means you use something in that year that has a capital depreciation. So in the IRS, you'll use this form, and I'd like to emphasize that down here, we see that depending upon the classification of the property, we'll either see it as being a 3-year property, 5-year property, 7-year property, 10-year property, and you have to go look up what the actual asset is and how it's classified. For example, a property would be listed at a 25-year property, and something maybe say like an HVAC system may be listed as a 7-year property. So they have rules on how you actually classify the properties. Vehicles, printers, fridges, things like that, they all get some sort of classification. And the same thing applies for CRA, the Canada Revenue Agency. So there's also other things which come in here, which is called the conventions. And when we look at conventions, they take a look at when was that asset actually put into usefulness. And so a convention maybe, sometimes they'll try and simplify things in the tax system and say there's a half-year rule, which says even if you bought an appliance on January 1st, you may only depreciate half of it in the first year. So that would be the half-year rule. This MM stands for mid-month. So sometimes what they'll do is they say, even if you bought it January 1st, instead of saying it was purchased on January 1st, you're going to depreciate it as though it was placed into service middle of the month, which would be January 15th, as an example. The method is what you guys have just learned in this lesson. SL stands for straight line. And up here we could put in DD for declining balance. And DDB could be double declining balance. So that goes to how we could actually apply this to real life. Remember that accounting is used for 3 users. Primarily the owner of the business. They want to try and find out accurately what the numbers are. 2 would be investors. You want to try and pitch something to them. Makes things seem really good. And 3 would be tax accountants, where you're trying to calculate taxes. Well, that concludes this lesson on depreciation methods. I hope you've enjoyed, and I hope you see how it can actually be applied to real life. As usual, practice will make perfect, and so you've got these questions here to try and attempt and apply yourself. Thanks for watching. If you have any questions, email me or ask questions in the Google Classroom.